Well, joining us now is BNY Investments chief economist and former Federal Reserve director of the Division of Monetary Affairs, Vincent Reinhart. It's great to have you back on the show. Welcome. I want to start right there because we've had a lot of Fed speak to start the week, and certainly Powell with his semi-annual testimony on the Hill, part one of 2 days here today. The market seems to be taking his messaging maybe slightly more dovish. I'm not sure it's the right way to take his messaging, but given what we've heard from others in recent days, your takeaway.
So first of all, I think you're right. On net, the FOMC outcome was somewhat hawkish, dovish rather, in the sense they left two easings priced in, but he reiterated that message that they're in no hurry. And that's the Chair Powell that showed up this morning on Capitol Hill. They're in no hurry. And he already had those Fed speakers on the tape talking about moving at the next meeting. He didn't swim up to that at all. I think sometimes market participants reverse engineer what happened in markets and put it into the words of Chair Powell. Fact is, oil prices are off 5.5%. I kind of think that you would trim your expectations of Fed firmness, given that it wasn't what Chair Powell said. It's what the oil market did.
So if you see energy prices fall, and even after the spike we did see, which we're coming back off of, going into this Israel-Iran war, we were still lower in crude oil than we were a year ago. So if you see those energy prices continue to fall, if you continue to see signs of housing deflation take root here, does that offset any potential inflation impact you would get from tariffs?
It prepares the ground for a better pass-through of tariffs to import prices and import prices to consumer prices. The good news is energy prices are really resonant with households. I mean, you think about them when you fill up the tank or pay the natural gas bill for your house. In that sort of environment, you're more sensitive to the effects on import prices. Well, if you don't have it, if in fact you're getting a windfall, maybe you're less sensitive and inflation expectations will be better contained. So it works in the right direction. However, the changes in energy prices are relatively small compared with how big a lift the Fed is probably expecting from tariffs.
Yeah, and of course we get that PCE inflation reading this Friday, and so far other readings we've gotten have been tamer than expected. Mike Santoli was just talking about the labor market component of this, these early signs perhaps of deterioration in the jobs market. Are you seeing that? And if so, or if not so, what would you be watching for to know that that's picking up steam?
So two parts to that. One is it's still a little early to see the tariff effects in PCE. It's beginning to build, but that wave is coming. With regard to labor markets, yeah, labor demand is no doubt softening. However, labor supply growth is slowing too because of the administration's views about the border. Stricter immigration enforcement and deportation means that we're maybe even having a decline in the number of workers, but it certainly slowed the growth, in which case you need slower labor demand to keep the labor market in balance. And that's pretty much the story of 2025. So the risk here, and I understand the concern, is the world's nonlinear. Sometimes the labor market slows and then just cracks. It doesn't feel like we're there yet, and some slowing in employment isn't so bad when labor supply is also slowing.